Welcome back to Intermediate Accounting. This is our last video on Chapter 18, Revenue Recognition. In this video, we're going to look at some special items that companies might encounter, specifically sales returns and allowances, repurchase agreements, bill and hold, principal-agent relationships, and consignments. Let's get started with sales returns and allowances. A right of return might be granted by the seller to the customer for products for various reasons, usually relating to the fact that the customer is unhappy or dissatisfied with the product. The company that's returning the product receives any combination of the following. They might get their money back, they might get a credit to be applied towards future payments, or they might get another product in exchange. Let's take a look at an example of accounting for sales returns and allowances. On January 12, 2020, Vendin Company sells 100 cameras for $100 each on account to the customer Amaya Inc. Vendin, the seller, allows Amaya, the customer, to return any unused cameras within 45 days of purchase. The cost of each product to Vendin Company is $60. Vendin estimates that three cameras will be returned. The cost of recovering the products will be immaterial, so it's not incurring much additional cost in getting the returns. Think about, are we charging the customer shipping to get those returned cameras to us? And the returned products are expected to be resold at a profit. So we think that the customer is going to return them not because they're defective, but something about the customer just doesn't like them, but we can resell them. On January 24th, Amaya returns 2 of the cameras because they were the wrong color. On January 31st, Vendin prepares financial statements and determines that it is likely that only 1 more camera will be returned. Vendin makes the following entries related to the transaction. Let's record the entry for the sale of the cameras and the related cost of goods sold on January 12th. This is a fairly easy, straightforward journal entry. It's simply a review of what we did in the first third of Intermediate 1 and throughout most of Accounting 221, the Introduction to Principles of Accounting. When we make a sale, we debit accounts receivable because this sale was on account. We sold 3 cameras, $100 each. We sold 100 cameras for $100 each, so accounts receivable increases by $10,000 and sales revenue increases by $10,000. When we're recording for the sale, we're counting for the sale, we also have to count for the cost of the goods that were sold. Remember, cost of goods sold is an expense. So we debit cost of goods sold to increase that expense. 100 cameras at a cost per camera to the seller Vendin Company of $60 per unit. Total cost of goods sold is $6,000, and we reduce Vendin Company, the seller's inventory, because those cameras come out of inventory and go to the customer. Now let's start accounting for the actual return. Let's record the entry for the 2 cameras that were returned on January 24th, 2020. So here's our journal entry on January 24th, 2020. We're going to debit the account sales returns and allowances. We saw this account briefly in Intermediate 1, and what I want to remind you of is that sales returns and allowances is a contra revenue account. Remember, on the income statement, the company typically reports net sales at the top of the income statement. And what is net sales? It's sales revenues less sales returns and allowances. So sales returns and allowances reduces net sales. And it is on January 24th, we're receiving 2 cameras back. So we want to undo the sales revenue related to 2 cameras, but we don't just decrease sales revenue because we want to be able to track and separately account for the merchandise that was returned or if we provide an allowance to the customer. And since the customer returned, what we're doing is essentially undoing part of this entry here. Instead of just debiting sales revenue, we're debiting the contra sales revenue account, sales returns allowances, and then we're also going to take off the accounts receivable. So the other side of this entry is going to be a credit to accounts receivable for 200. And just like we had another section of our journal entry at the cost of the merchandise that was sold, we're going to do a similar entry to undo. And we're going to add back. We just received the cameras back from the customer. We were told that we can resell them. They were simply the wrong color for the customer. So we're going to increase inventory. But just for our record keeping purposes, we're going to have a special account, not just debit inventory, but debit a special account called returned inventory. And we're also going to remove this cost of goods sold that we had previously recorded this expense. So let's book that portion of the entry. The debit to increase the asset returned inventory for 120. This is the cost of the inventory. The 2 cameras were returned and the cost of the inventory. Whereas the $100, remember, was the selling price of the goods. So returned inventory, this is an asset account. It's going to be reported together with inventory, or maybe the company's going to report it right below in the inventory account on the balance sheet. And then we are crediting to reduce the expense account cost of goods sold. So just note that a credit to cost of goods sold reduces expenses. And of course, if we're reducing expenses, what we're doing is increasing income with this portion of the entry. Because if those cameras were returned, we don't have that expense related to 2 of them. Let's continue with this. The company, remember, we told that the company estimates that 3 cameras are going to be returned related to the sale of the full 100 that were sold. So when we actually get the cameras, we record the return for those units, those 2 units that we received. But by the time we're putting together the financial statements, we need to record an adjusting entry for the fact that we expect that 1 more camera is going to be returned. We are going to debit sales returns and allowances on that 1 additional camera we expect to be returned in the future. This is the same thing we did when we actually had the return, debit sales returns and allowances, which decreases revenue because it's a contra revenue account. This time it'll be for the 1 camera, the expected future return at the selling price of 100. Then the account that we're going to credit is called allowance for sales returns and allowances. For the 100. So what is this account? A credit to allowance for sales returns and allowances. This account is a contra asset. And let's look back at the entry that we recorded when the customer actually did the return and we received the merchandise. Took that amount out of revenue and we reduced the accounts receivable. So we want to undo that. We want to undo a receivable, but we haven't gotten that camera from them. So we don't want to take the receivable out immediately because perhaps our estimate was wrong. So we use a separate account, allowance for sales returns and allowances. And this is a contra asset and it reduces accounts receivable. So again, why not just simply reduce accounts receivable? Well, because we didn't get that actual, we're still just estimating a future reduction to accounts receivable. What other time in financial accounting have we booked a contra asset that reduces accounts receivable? Remember, that was the allowance for doubtful accounts. This has the same balance sheet impact. It reduces the accounts receivable or net realizable value of accounts receivable, but it differs from allowance for doubtful accounts because that is related strictly to credit. This is, we're reducing accounts receivable for an expected future return. Okay, so just like this last entry, we took out the sales amount, selling price of the goods. Now we need to make a similar entry for the expected returned inventory and the expected reduction to cost of goods sold. So in the second portion of the asset, of the entry, we are going to debit, instead of inventory returns, estimated inventory returns, just so we make it clear in our general ledger that we haven't actually gotten that inventory yet, but we expect to. And this, just like last time, is going to be at cost. One additional return that we're expecting at the cost to us. It cost us $60 either to make or buy that camera. But let's increase inventory for the estimated future inventory return. And then let's decrease cost of goods sold, decrease expenses, because we expect to get that inventory back, which would reduce our expenses. So what would the balance sheet and income statement report when those financial statements are put together on January 31st? Let's take a look at that. Vendon, the seller's income statement for the month ending January 31st, 2020, is going to report sales revenue at the full amount. Remember, this is not net of returns. We're going to do that separately. We're going to report to the investors or any users of the financial statements how much is our estimated returns and allowances. So sales revenue was the 100 units at $100 per unit's selling price. Sales returns and allowances, is this going to be for 2 cameras or 3 cameras? It's going to be the total 3 cameras. So we booked a $200 increase to the contra revenue account sales returns and allowance on January 24th. And then as an adjusting entry, we booked an additional $100 increase to sales returns and allowances. So the 200 plus the 100 that was booked at year end is an adjusting entry, 300. So top of the income statement is going to report net sales or sales common net of 9,700. From that, we're going to subtract out cost of goods sold, which was 97 units, because this is net of returns and expected returns, times the cost per unit of 60. Or we could go back to our entries and say cost of goods sold increased by 6,000, then it decreased by 120, and then it decreased by an additional 60. Either way, we should get to the same total amount of 5,820. So the income statement is going to report gross profit. Net sales minus cost of goods sold, 3,880. And how about the balance sheet? The balance sheet is going to report accounts receivable. Remember, at the time of the sale, the company booked the increase to the asset accounts receivable of $10,000, and then 2 of those cameras were returned. So we had to reduce that accounts receivable. So $10,000 minus the 200 for the returns that actually took place, or 9,800. From this, we're going to subtract out our allowance for sales returns and allowances, of 100 that we booked for our estimated future return, and then we're going to report accounts receivable net, or net accounts receivable, of 9,700. What else is the balance sheet going to report below accounts receivable? It's going to report the returned inventory, including the estimated returns. Or maybe the company will report 2 lines, one for returned inventory and one for the separate account estimated returned inventory. For 180, which is of course the cost, $60 per unit times the 3 that either have been returned or are expected to be returned. And I could put a subtotal here, but we know this is probably not all of the company's assets. The balance sheet would just continue on there. Now, this example, when Vendon was the seller, assumes that the customers had a sale on account. Let's take a look at what would happen if we have a situation where the customer paid cash at the time of the sale. So now assume that Vendon sold the cameras to Amaya for cash instead of on account. In this situation, Vendon makes the following entries related to the transactions. So again, first entry, recording the sale, very simple. The company receives cash for the full 100 cameras at $100 each. So cash goes up 10,000, and of course, sales revenue goes up 10,000. No change to cost of goods sold, so cost of goods sold increases by 6,000 when the 100 units times the $60 cost to vending company, the seller, per unit, and we decrease inventory for 6,000. Now let's go back to the new material. Now, just like we did before, except before we had to account for the fact that we're not going to receive a receivable that we had initially expected. So what happens? Vendon, let's record the entries to return the 2 cameras that Vendon received, the customer returned, and the cost of goods sold. So just like we did when the sale had been on account, we're going to debit sales returns and allowances because our customer returned some merchandise. This is at the selling price. Remember, this is going to reduce our net sales. Again, this is a contra revenue account for the 2 cameras that were returned at their selling price. Now, what do we take off here? Well, we need to return the cash to the customer. So either we credit cash here and return that cash, or we expect to. So we either have a credit to cash or we plan to return the cash in the future. So we owe cash, so we can similarly credit accounts payable if we're going to make that cash return in the future. We get the inventory, so just like last time, we're going to debit the specific inventory account called returned inventory at cost, the cost to the seller Vendon, 2 units times $60 per unit, and we're going to take away the cost of goods sold expense that was previously booked when we had the sale of the 100 units. Now we're reducing it for the 2 units that no longer have been sold. And what about that next step? When January 31st, when the company prepares the financial statements, they need an adjusting entry because they expect 1 more camera, 1 more unit is going to be returned. So that adjusting entry, just like before, we're going to debit sales returns and allowances for that 1 unit at a selling price of 100, and then credit. This time we're definitely not giving out the cash because who are we sending the cash to? This is just an expected return. So we're going to credit for sure accounts payable. We're going to owe cash once we receive the return from the customer. And the amount, of course, is at the sales price. We also are expecting to receive those goods back from the customer. So we're going to record that to estimated inventory returns in asset account. The cost of 60, and then we're going to take it out of cost of goods sold. What would the income statement and balance sheet look like if the transaction had been for cash? Well, the company still has sales revenue of 10,000, just like before, 100 units times selling price per unit of $100. From that, we subtract sales returns and allowances. We're expected 3 units, a selling price of 100 each, so we subtract out 300. And so we can see here, regardless of whether that transaction is cash or receivables, cash or credit, we still have net sales of 9,700. And we still have cost of goods sold, 97 units times the cost per unit of 60. Which gives us the same gross profit that we saw before, 3,880. And that makes sense. Whether we had the sale on cash or for a receivable, those are both balance sheet. We're changing the balance sheet, not the income statement. So let's look at what happens on the balance sheet. If we assume that, well, let's say, assume we didn't make that. And so when we went here, we know theoretically it could have been cash. But let's say we didn't make a payment yet to the customer for that return because we don't have a beginning balance in cash. We're not going to report cash as a negative amount. Assuming no payment to customer, we still have the 10,000 from the initial sale. We have return inventory, including the estimated future return. 3 times 60 units, so 180 units we estimate, 2 that we actually received returns on, and the 1 we estimate will receive at their cost of 60 per unit. And then we would also report this in the asset section, the current asset section, and in the current liability section, we would have accounts payable. For the 200, we know we have to pay the specific customer Amaya from here, and then our estimate, we don't know which customer is going to return. We think one will, and then we will owe them $100. So 200 plus 100 for a total accounts payable balance of 300. Let's move on now to the next topic, repurchase agreements. Repurchase agreements allow a company to transfer an asset to a customer, but have an unconditional, sometimes we call this a forward obligation, or an unconditional right, a call option, to repurchase the asset at a later date. If the obligation or the repurchase is for an amount that is greater than or equal to selling price, then it is a financing transaction. Let's look at an example. Morgan Inc., an equipment dealer, sells equipment on January 1st, 2020 to Lane Company for $100,000. Morgan Company agrees to repurchase this equipment on December 31st, 2021 for a price of $121,000. So what's going on here? Morgan sells the equipment, but promises that at the end of 2 years, it's going to buy it back. So what happens from Morgan's perspective? They get cash January 1st. They repay cash of $121,000, so $21,000 additional at the end of 2 years. What is that $21,000 additional cash that the company is going to pay above what it received? That looks like interest. Question, should Morgan Inc. record a sale for this transaction? Assuming an interest rate of 10% is imputed from this agreement, Morgan Company makes the following entry to record the financing on January 1st. So we don't record this as a sale as if the equipment was simply sold to a customer, because there's an agreement. Morgan is obligated to buy back. They have a liability. They have to buy that equipment back at the end of the 2 years. So Morgan Company receives cash in the amount of $100,000. And the other side of that entry, which is really important, is not a sale of equipment. We don't even know what the cost is to the company or the selling price per se, like a normal transaction. But what we do record here is a liability. We are obligated to buy that equipment back from the company. Instead of having our liability at $121,000, we're going to record this liability for $100,000, and as time passes, we're going to increase this liability due to interest expense on this transaction. So let's look at how the journal entry would look. Morgan Inc. records interest on December 31st, at the end of the first year. What happened every moment that has passed between January 1st and December 31st in 2020? The company has the cost of borrowed money interest expense. And instead of companies not paying cash for that, we are increasing that liability. Remember, when we credit a liability, we are increasing that liability to Lane Company. And this is in the amount of, well, we take the initial amount borrowed, the $100,000, and multiply it by the implied or imputed interest rate times the time portion of the year, 12 out of 12. So what would the 12/31/2020 balance sheet and income statement report? The balance sheet would report a liability of $110,000, the initial $100,000 plus the additional 10 for the time value money, the interest portion, and the income statement would report interest expense for $10,000. The last entry related to this transaction is at the very end of this transaction. On December 31st, 2021, Morgan Company is going to repurchase that equipment back. So Morgan Company needs to record additional interest expense, the interest expense that relates to the accounting period 2021, an additional increase to the liability to Lane Company. This is in the amount of the beginning balance in the liability times the imputed interest rate of 10%. Or we can look at this as our liability started out as 100,000. As time passed, we recorded interest expense, we increased it to 110, and we know that we're going to have to pay off 121, so that additional amount is booked here as another increase to the liability. But then immediately what happens on that same day, the company pays off that liability. So we credit cash to make payment for 121,000. And what account are we going to debit? We're going to debit to reduce the liability to Lane Company for the full 121,000. So what would we see on the financial statements? The income statement is going to report for 2021 interest expense of 11,000 and no liability whatsoever. We just reduced cash and paid off our liability. Let's move on now to our next topic, bill and hold arrangements. Bill and hold arrangements are contracts under which an entity, the seller, bills the customer for a product. That customer has the legal right to it, but the seller still has physical possession. Oftentimes we say a sale occurs at the time that the company transfers ownership or control over to that customer. Well, here the company is still transferring the ownership, but they still actually physically hold them. So we're saying it does belong to the customer, but we're holding it for them. This results when the buyer is not ready yet to take delivery, but does take the title and accept the billing. We want that, but we just really need you to store it for us until we're able to pick it up. Let's take a look at an example. Butler Company sells $450,000 of fireplaces on March 1st, 2020 to a local coffee shop. The coffee shop is Baristo and is planning to expand its locations around the city. Under the agreement, the customer, Baristo, asks Butler to hold on to those fireplaces until the new coffee shops are ready. Title passes to the customer at the time that the agreement is signed, but bear in mind those fireplaces stay with Butler even though the title passes to the customer. Question: when should Butler recognize the revenue from this build and hold arrangement? Butler determines that it's satisfied its performance obligation to transfer the product. Now, typically this is going to be when the actual product switches hands and goes to the customer, but if it's a bill and hold, we're going to say we evaluate when the customer, Baristo, the customer, obtains control of the product. And even though it is in Butler's warehouse, we're saying we are transferring control. So then we can satisfy the performance obligation even though we haven't delivered it yet. And here are some requirements that the companies need to meet in order to recognize revenue. The seller, even though they're holding on to it, in order to recognize the revenue, we have to meet all of these conditions. First one, the reason for the bill and hold arrangement must be substantive. We have to have a real reason. We can't just be doing this to get our financial statements to look the way that the seller wants them to. The product we're talking about here, in this case the fireplaces, must be identified separately as belonging to the customer. So in Butler's warehouse, they have to separately position those fireplaces and put a sign on them so that they're not going to get sold to another customer. The product currently must be ready for physical transfer to the customer. We can't recognize revenue as the seller if these goods are not complete. And the seller, let's say instead of Butler, to make this more for the customer, just to make this more generalized, seller cannot have the ability to use the product or to give it to someone else. So we say use the product or to direct it to another customer. No selling those fireplaces to somebody else. In this case, it appears above criteria were met, therefore revenue recognition is allowed even though we didn't give those fireplaces to the customer. Let's record these entries. Butler, the seller, makes the following entry to record the sale on March 1st, even though we haven't delivered, Butler hasn't delivered the fireplaces. We say accounts receivable has gone up. We have done our part. Now we're just storing them. We have the right to receive cash from them, and we are recording that sales revenue. They are in a section of our warehouse, complete and ready to be picked up whenever that customer is ready. Butler makes an entry to record the related cost of goods sold. For recording the sale, we should also record the cost of goods sold. And remember, we were told in our example that the goods cost Butler $280,000. So debit to increase cost of goods sold for $280,000 and credit to reduce inventory for $280,000. All right, let's move on to our second to last topic, principal-agent relationships. Think about Priceline. Priceline is providing this service, but when they're selling, let's say, a rental of a hotel, and Priceline's collecting that full amount from the customer, but it can't recognize that entire revenue. That doesn't belong to Priceline. It sends most of that revenue directly to the hotel that the customer just booked, but it keeps the commission. So amounts collected by the agent on behalf of the principal are not revenue of the agent. Again, when Priceline collects $200 for a hotel room you booked at the Marriott, Priceline doesn't record revenue of $200. Priceline is the agent. The principal in that case would be Marriott. What can Priceline record? So revenue for the agent. It's the amount of commission. Let's say Priceline is charging Marriott 2%. That's their revenue, the 2%, not the full amount of cash received. All right, let's move on to our last topic, consignments. Manufacturers or wholesalers deliver goods, but they retain the title to the goods. Until those goods are sold. The consignor is the person who has the title, the ownership of the goods, but they don't have physical possession. They ship the merchandise to the consignee, who is the seller or the dealer. The consignee acts as an agent for the consignor. They are the ones that sell, promote merchandise. The consignor makes a profit on the sale and then carries the merchandise as inventory. We learned this in Intermediate 1. And the consignee makes the commission on the sale. They're the seller, the dealer. Now let's look at an example where we'll do the books, we'll record the transaction for both the consignor and the consignee. Nelba Manufacturing Company ships merchandise costing $36,000 on consignment to Best Value stores. So Best Value is the dealer. Nelba pays $3,750 of freight costs, and Best Value pays $2,250 for local advertising costs that are reimbursable from Nelba. By the end of the period, Best Value has sold 2/3 of the consigned merchandise for $40,000 cash. The dealer notifies the consignor Nelba of the sales, retains a 10% commission, and remits the cash due to Nelba. Let's record these journal entries, both sides of the transaction, step by step. So first thing that takes place, Nelba Manufacturing Company ships merchandise costing $36,000 on consignment to Best Value stores. So clearly, Nelba is going to take this out of its the goods out of its finished goods inventory and put it into its actual consignment inventory. This is our finished goods inventory, and move it into inventory, and we might make a special account or note that this is consigned goods at the cost of $36,000 and no entry for the consignee. They receive these goods, but they don't make the entry because the consignor continues to hold them in their inventory. Now, let's say we're taking this out of finished goods, but if the company had produced it, we could record the cost of producing that inventory. Next, NELBA, the consignor, pays $37.50 of freight costs. So if we're the company that owns the inventory and we're responsible for freight costs, we add that to the value of the inventory. So NELBA is going to increase the account inventory, consignment inventory, for the amount of the freight, $37.50, and then we're paying that, so cash or accounts payable, if it's been just billed, $37.50. The consignee does nothing. They receive these goods, but no, they don't record it on their books because they don't have title ownership to them. Next, the dealer pays $22.50 for local advertising costs that are reimbursable in the future from the consignor, NELBA. So the consignor doesn't even know about this. We don't see anything about Best Value sending the bill to NELBA. Once we do, then we'll worry about that transaction. So the company, the consignee, Best Value, the dealer, spends cash, so I'm crediting cash for $22.50. And what account am I going to debit? Not an expense account. Why? Because these advertising costs, so you might be thinking advertising expense, but it's not an expense to the consignee. So these advertising costs are reimbursable. We say NELBA owes us cash, so we have a receivable from the consignor. For $22.50. Next, by the end of the period, Best Value has sold 2/3 of the consigned merchandise for $40,000 cash. Now, we don't see anything about Best Value notifying the consignor we've sold the merchandise. So for now, until the consignor is notified, it makes no entry. And the consignee, the dealer, receives cash from the customers, $40,000, and now records that not as revenue, but as a payable to the consignor. And then at the very end of the period, everybody settles up. At the end of the period, Best Value notifies NELBA of the sales. Best Value retains a 10% commission, and Best Value remits the cash due to NELBA. So from NELBA's perspective, NELBA is receiving cash. How much? Well, it's going to be the $40,000 that the sale was, the sale of the merchandise of $40,000, less any amounts that NELBA owes. Remember, NELBA still owes 10% commission, and NELBA also owes Best Value for payment of that those advertising costs of $22.50. So let's hold off on the amount of the cash and let's keep going with NELBA's entries. NELBA records advertising expense because even though Best Value ran the advertising, the contract was set up so that NELBA was responsible for payment and its benefits, the cost incurred, is going to benefit NELBA, so it's an expense to NELBA for $22.50. There's commissions that NELBA incurred, the 10% commissions by Best Value, so we debit to increase commissions expense for $4,000 or 10% of the sales price of $40,000 on those consigned goods. And then NELBA recognizes revenue, or we might specifically say revenue from consignment sales for that full $40,000. So how much was the cash payment, the cash received from Best Value? It's the $40,000 less Best Value keeps $22.50 as a reimbursement for the advertising and keeps $4,000 as its commission. So the amount of cash that Nelba receives is $33,750. What about from best value's perspective? Best value is going to get rid of this liability payable to the consignor for $40,000. So we're going to debit to decrease the liability payable to consignor. And we're not going to give them the full $40,000. We're taking that off the books. But what do we reduce that by? Well, we're getting the cash, or we're going to give the cash to Nelba. So we are going to reduce this receivable from the consignor of $22.50. So I need to credit to reduce the receivable from consignor. Best value needs to record its commission revenue of $4,000, and the rest is going to be cash. So while we don't see a debit to cash and a credit to commission revenue for $4,000, we are actually getting the cash by reducing the amount of cash that we pay to Nelba. We are pulling out $4,000 of that cash. We're pulling out $22.50 to pay off what we had previously paid for the advertising. And then that difference of $33,750 is what we pay to the consignor Nelba. And that concludes our last topic and last video for revenue recognition.